Welcome to the Opening Bell Report.
Today, we are unpacking a story that, honestly, if you wrote this as a screenplay, producers would probably tell you it's a little too on the nose.
Yeah, a little too perfect.
We're dissecting a stack of analysis reports on a single stock that basically woke up one morning and decided to rally almost 200% in one day.
It's a staggering number,
Yeah.
specifically 191%. And, you
Yes.
know, when you see a number like that flashing across the screen, your first thought is usually, okay, what happened? Did they cure a major disease?
Right. Or did Elon Musk tweet about them by accident? But the ticker symbol here is just, it's almost too perfect. IVF, INVO fertility.
You have to give them credit for that one. That's prime real estate.
It is. But let's look at the snapshot here because the volatility is just, it's eye-watering. The stock closed the day before at 81 cents. A penny stock, completely under the radar. Then, boom, it hits a high of $4.58 during the day before settling back down at $2.37.
And that intraday range right there, that's what we really need to focus on. Going from 80 cents to almost $5, I mean, that is life-changing money for a day trader who gets it right.
Or an absolute nightmare for the person who bought at the top.
Exactly. It's a massive transfer of wealth in, what, about 6 hours of trading?
So that brings us to the mission for this deep dive. We've got these reports in front of us, and we need to answer the big question everyone is probably asking. Is this real?
Is it fundamental?
Yeah. Is this a real turnaround where the company is suddenly making a ton of money? Or are we just looking at something mechanical, a classic low-float squeeze where the price just creates its own reality?
That is the multi-million-dollar question. I mean, on the surface, the chart looks like a rocket ship.
Yeah.
But when you dig into the footnotes of these reports like we have, you find some hidden risks that are, well, they're absolutely critical.
So breakout or trap?
We need to figure that out because there's a very specific reason this happened, and it's not just about babies.
Okay, so let's start with the bull case. Let's be optimistic for a minute. Usually when I see a stock jump 200% on what looks like no news, I assume it's a scam.
That's a healthy assumption.
But looking at the financials in this report, this isn't a company with zero revenue. There's actually some, meat on the bone here, isn't there?
There is, and that's what makes this whole thing more interesting than your typical pump and dump. The report highlights a massive growth metric, a 116% year-over-year revenue increase.
116%.
They're hitting approximately $6.3 million in trailing 12-month revenue.
That's serious growth. But we need to contextualize that, right? Where's that coming from? Because a lot of these small healthcare companies, they just have like one-time milestone payments. This feels different.
It is different. This is operational revenue. The report details a pretty significant shift in their business model. INVO Fertility isn't just selling a concept anymore.
So what are they doing?
They've started acquiring clinics. Specifically, the report notes they bought a group called Family Beginnings.
So they're vertically integrating. They own the tech, and now they own the clinics where the tech is actually used.
Exactly. They're capturing the whole value chain. Instead of just selling a device to a doctor for a small cut, they're performing the procedure and billing the patient directly.
So that's the revenue jump.
That's why you see that revenue basically doubling. They are, effectively buying revenue, sure, but it proves the concept works.
Let's talk about that concept. The device itself, InvoCell. The notes here describe it as a disruptor. Now, I'm not a biologist, but the elevator pitch seems to be that it's a natural incubator. How is that different from traditional IVF? Because to me, IVF means test tubes and expensive lab equipment.
This is the fascinating part of the story here. So with traditional IVF, you extract eggs and sperm, you put them in a petri dish, and you stick them in a high-tech, extremely expensive laboratory incubator for a few days.
Right. It needs a whole lab, embryologists, all of that.
It's incredibly capital intensive, which is why IVF costs tens of thousands of dollars.
It's basically a luxury service for a lot of people.
Precisely. InvoCell changes the venue. So instead of a lab incubator, the eggs and sperm go into this small device, the INVO, and that device is placed inside the patient's body.
Wait, literally inside the body?
Yep, it's called intravaginal culture. The patient's own body provides the temperature stability, the pH balance, all of it. You're basically using the human body as the incubator.
That is wild. But I get the economic argument immediately. You cut out the expensive lab.
You cut out the heavy lab overhead. The report positions this as a democratization of fertility. If you can offer a solution that is, say, 50% cheaper than traditional IVF.
Especially in this economy.
Especially now. That is a very compelling pitch.
We're in this weird spot where consumers are squeezed, but, people don't stop wanting to have families.
Wow.
So logically, the Costco of IVF, if you will, should win.
That's the narrative. In a tight economy, healthcare value plays often outperform. So the fundamental bull case is actually pretty strong. Revenue's up. They have a cheaper product.
But then there's this other piece of news in the report that felt uh, distinct. The merger. They're merging with NAYA Biosciences.
Yes, this happened relatively recently.
And this stopped me because NAYA is focused on oncology, cancer treatment. So now we have a company doing fertility and cancer. It feels a little like a scattergun approach, doesn't it?
It's definitely a unique combination. Usually you see small cap companies trying to hyper-specialize, dominate one niche. Merging fertility with oncology is unusual.
So what's the logic? Diversification? Or is it just bundling assets to stay listed?
Well, that's the cynical and maybe realistic view. The bull case is that they're building a broader healthcare portfolio. But it does complicate the story. Investors like simple stories. We treat cancer, Andy, help you get pregnant is a complex elevator pitch.
Okay, so we have the fundamental picture. Doubling revenue, cool tech, slightly confusing merger. If we stop there, I'd say, okay, maybe the stock went up because the business is improving.
But not 191% in 6 hours.
Exactly. That doesn't happen just because you bought a clinic.
Yeah.
That feels like something broke in the plumbing of the market.
You're spot on. Fundamentals are the spark, but they're rarely the explosion. For a move this violent, you need market mechanics.
This is where we get into what the report calls the technical rocket fuel.
The analysis is pretty explicit that this rally was driven by the structure of the stock, not just the substance of the business.
And it all comes down to one event.
Correct. The report points to a very specific event that happened in November 2025, a 1-for-8 reverse split.
Now, I want to unpack this because I think a lot of people hear reverse split and just think bad news. But mechanically, why does it act like gasoline on a fire? The company's value doesn't actually change, right?
Right. In terms of total value, it's cosmetic. Think of it this way. You have a pizza cut into 8 slices. A reverse split is like taking those 8 slices and melting them back together to make one single big slice.
Okay, so same amount of pizza, just fewer pieces.
Exactly. But here's where the supply dynamics kick in. When they did that 1-for-8 split, they consolidated the share count. They drastically reduced the float.
The number of shares available for the public to trade.
Yes. And the report says the float is now incredibly small.
How small are we talking?
Tiny. Fewer than 1 million tradable shares. In the world of the NASDAQ, that is microscopic. Apple has a float in the billions.
So this gets us to the low float squeeze. Walk us through the psychology here. Why does a small float equal such a big price jump?
It's the law of supply and demand in its purest form. So imagine the news hits. IVF revenue up 116%. Algos read it, day traders see it, and they all say, this is good news, I want to buy.
So they all hit the buy button.
But because of that reverse split, there's almost no one selling. The inventory of shares is empty. So to find a seller, the price has to jump. It ticks from $2 to $2.50 to $3.
And then FOMO kicks in.
Precisely. Momentum traders see the ticker flashing green and they pile in. So now you have this massive demand chasing microscopic supply. It creates a vacuum. The price has to go vertical just to find someone willing to sell.
So it's not that the company became 3 times more valuable in an hour.
No, it's that the market mechanics forced the price there to satisfy the buyers. You're not buying value at $4. You're paying a scarcity premium.
A premium for liquidity. That's a dangerous game.
Very dangerous game.
Let's bring this back to reality then, because eventually the squeeze ends and you're left holding shares of a business. The report does a really interesting David versus Goliath comparison to show us what we actually own here.
This was my favorite part of the analysis because it really grounds everything. They compare INVO fertility R David to Progeny, ticker PGNY the Goliath.
Progeny's the big one in this space, right?
They're the gold standard. They manage fertility benefits for huge companies. Microsoft, Google, you name it. Progeny is mature, profitable, stable. They trade at a price-to-earnings ratio of about 30.
Which is pretty standard for a quality growth company. They have earnings, so they get a PE.
Exactly. They have the E. INVO, on the other hand, is in the hypergrowth speculative phase. But the most alarming contrast isn't the size, it's the cash flow.
Okay, this is where the numbers get scary. Progeny generates cash.
Right. Positive 15% of sales. For every dollar they bring in, they keep 15 cents as cash flow. It's a self-sustaining machine.
And INVO.
INVO is burning cash at a rate of negative 120% of sales.
Whoa. Let's pause on that. Negative 120%. So for every dollar of revenue they generate, that $6 million we were just celebrating, they're spending more than $2 to get it.
Essentially, yes. They're spending heavily on SG&A, on the merger, on operating the new clinics. I mean, this isn't uncommon for startups. It's the burn rate. But when you're a public company, you can't burn cash forever.
You need a runway. And looking at this report, their runway looks, well, it's more like a cliff edge.
The cash on hand figure is the most critical risk factor in this entire story. The report states INVO recently reported having only about $350,000 in cash.
350,000. I mean,
Yeah.
for a NASDAQ-listed biotech company, that's what, payroll for a week?
Maybe less. It's terrifyingly low. It puts them in a position of extreme fragility. And this connects directly back to why the stock rallied and what might happen next.
I think I see where you're going with this. If I'm the CEO of INVO and I have basically no money, but my stock just tripled.
You pick up the phone to your investment bankers immediately.
It's the dilution risk.
Precisely. When a cash-poor company sees its stock squeeze like this, they view it as a lifeline. They can issue new shares, do an offering at these elevated prices to raise the millions they desperately need.
So if they sell stock at $3, they can fill up the bank account. But what does that do to the person who just bought at $3 thinking it was going to 10?
It crushes them because suddenly that low supply, the low float that caused the squeeze, gets flooded with new shares. Supply goes way up, demand stays the same, and the price crashes.
So the report is basically screaming, watch out for an offering.
It is the sword of Damocles hanging over this entire rally. You might wake up tomorrow and see a press release. INVO raises $5 million, and the stock will likely gap down instantly.
That's the catch-22. They need the money to survive, but getting the money hurts the very shareholders who just drove the price up.
It's a necessary evil for the business, but a disaster for the short-term trader.
So with that risk in mind, let's look at the technical levels. If someone's listening and looking at their screen, what are the lines in the sand?
The report outlines 3 key zones. First, the downside support. The stock needs to hold $2.
$2. Why that number?
It's partly psychological, a round number, but it's also where a lot of the trading consolidated after the initial pop. If it breaks $2, the report warns of a gap fill.
Explain that. Filling the gap.
Remember, it jumped from about 80 cents to $2 overnight? That whole area on the chart is empty. There was no trading there. So if the price slips into that zone, there's no structural support. It's like an air pocket.
So it can fall very fast.
Very, very fast. It can slide from $2 all the way back to 80 cents with very little friction.
That's a 60% drop. Okay, what about the upside?
If the bulls are still in charge, they need to break the high of the day, $4.58.
That's the new ceiling.
If they can break that, it proves this isn't just a one-day wonder. But the momentum seems to be cooling. The report noted that in after-hours trading, the stock pulled back to $2.02.
So it's hovering right on that danger line. It's teasing the breakdown.
Literally teetering on the edge of the gap. It suggests profit-taking. The people who bought at 80 cents, they're selling. They aren't sticking around for the merger to work out in 2027.
Which brings us to the verdict. The analysis summarizes INVO as an exciting speculative watch that feels like polite analyst speak for high risk, high reward.
It is. The conclusion is nuanced. The revenue growth is real. This isn't vaporware. The clinics exist, the tech works. But the balance sheet is a disaster.
So it's a race. Can they fix the balance sheet before they run out of money?
That's the bet. The strategy suggested here is to treat this as a trader's market. This is not a buy and hold for your retirement stock. Not yet, anyway.
Don't chase a green candle.
Never chase a parabolic move on a low-float stock. You will almost always get burned. If you believe in the tech, wait for the volatility to die down, wait for the offering.
And if you're already in?
Hard stop losses. Do not trade on hope. If it breaks $2, get out and reassess. The market doesn't care what price you paid.
It's a brutal reminder that the stock market is really 2 different games. There's the business game revenue, products. And INVO is, well, it's doing okay there.
And then there's the trading game float, volume, squeeze. And in the short term, the trading game always wins. Right now, INVO is a trading vehicle. Maybe one day it's an investment, but today it's a casino chip.
I want to leave our listener with this thought to mull over. We get so fixated on these games, up 191%. But think about that cash position, $350,000.
It's the price of a studio apartment in New York City.
Right. So the question is, does a triple-digit revenue jump actually matter if the company is running on fumes? At what point does the growth story just collapse under the weight of the cash reality?
That's the tension. Are we looking at the next big disruptor that just needs a cash infusion to fly? Or are we looking at a company gasping for air, using a stock squeeze as one last breath?
And that's the difference between an investment and a gamble. Make sure you know which one you're making. Thanks for diving deep with us on INVO fertility. It's a wild chart and an even wilder story.
Stay sharp, everyone, and watch those levels.
Don't forget to like, share, and subscribe for more.